Welcome to the video on equity and its types. Equity, as we know, represents ownership in a firm or an asset. For instance, the owner of house worth $200,000 that has $80,000 in mortgage loan is said to have $120,000 in equity. Equity, also known as stock, represents ownership interests in corporations. If you own 100 shares of value $1,000 in a firm, you are said to have an equity of $1,000 in the firm. Equity instruments are generally associated with more returns. They are risky since they can also go down quickly in value or propitiate a share if the firm runs in losses. Equity instruments include equity shares, preference shares, convertibles such as fully or partly convertible debentures, and warrants. Equity primarily is of two types, such as common stock, preference stock. Common shares allow an individual to enjoy the profits of the issuing company in form of dividends paid to the shareholders. The shareholder is also entitled for an increase in the market price of the share when the company retains a part of its earning or pays off previous debt from the current earnings. Common stock is the sum of securities. It represents the shareholders' equity ownership in a corporation, provides them voting rights, and entitles them to a share of the company's success through dividends and/or capital appreciation. The individual can exercise this voting right during the election of directors. Preferred stocks are also called as preference shares. A preference share enables a shareholder with the right to obtain regular dividends from a company. The amount or the rate of dividends is pre-decided. The dividends are either in form of fixed annual payments or are based on a money market index. Preferred shares obtain this name because they have a preference over the common shares during payment of dividends or during liquidation of the company. Equity markets are classified based on the way they are issued or traded. When the company is initially going public, they take the route of the primary market, and later on they are traded on the secondary market among the market participants, where company is not necessarily a party to the trade.
The primary market is that part of the capital markets which deals with the issuance of new securities. Companies, governments, or public sector institutions generally obtain funding by tapping the capital market through the sale of a new stock or issue of bonds. This is typically done through a syndicate of security dealers. The process of selling new issues to investors is called underwriting. Primary market shares can be bought directly from the issuing company. If a company sells its share to individual investors for the first time, it is referred as initial public offering, IPO. A company may also issue fresh shares to distribute its profits to its shareholders. This is called bonus issue. This is another way to obtain a company's share. Another method to acquire shares directly from the firm is Employee Stock Ownership Plan, ESOP. It is a plan under which the employees of a company acquire its stock as a part of their compensation or reward program.
While in a primary market, the securities are issued directly by the company. In a secondary market, securities that have already been issued in an initial private or public offering are traded. In secondary market, the shares that have already been issued are bought and sold. Secondary market provides liquidity to the shares, as the investor can buy or sell their shares here. The secondary market operates through the medium of stock exchange that regulates the trading activities in the market and ensures a measure of safety and fair dealing to the investors.